everybody. Nathan Long, President of Quest Trust Company, and thank you for joining our educational series. This one says Problems and Solutions in Buying Commercial Real Estate and Other Entities and IRAs. It should be a good talk. We're going to talk about, structure and those type of things as we go through here. I will tell you, I'm not going to go into some of the basic stuff that I go to in some other presentations. I'm going to delve right into the problems that we have when we're dealing with entities as we go through. If you need some of that basic information, look at some of our other education things. And really important part of this presentation is to understand that Quest Trust does not provide tax, legal, or investment advice. We don't sell anything. We don't endorse any products. We don't sell any investments. We don't get any commissions off of investments. And I'm certainly not trying to tell you how to structure deals. I am trying to provide some education on some things that you should think about when doing these types of transactions. It is not designed to be a course in its entirety of everything you should think about, but some of the things that cross my mind as I see it from the perspective of a self-directed custodian. And hopefully you'll find the education helpful to make the right decisions. Because the reality is the power of self-directed IRAs is powerful because of the education that goes along with it so that you can make the decisions that are right for you. Because with most of these things, you just can't throw a blanket over and one policy or one way of doing things is right for everybody. We're all different people with different needs, different wants, different income levels, different skill levels, different ages, different children, and all of these things affect what we do. So make sure you're checking out and talking to your own professionals and understanding. If you don't understand something, always call up here and ask for an IRA specialist and just chat. Often you can come up with some good ideas to help come to problems resolutions. So what is an entity? I'm talking about an entity here. At Quest, we have an entities department. Why? Well, at Quest, we break up the type of assets you own. A lot of people have this belief that you have to have an LLC inside an IRA in order to self-direct it, which is absolutely not true. We have all types of direct purchase of real estate that's owned in an IRA, and I have a department that is that's all they do is take title directly to real estate and IRAs, and do the whole thing, the closing, paying the taxes, all of those things that happen, the repairs, receiving the rent monies back in, everything. And we have a department that just buys notes, direct purchase of notes without the use of an LLC or any other type of entity. These are people that buy performing notes and non-performing notes, existing notes, creating their own notes that are secured by real estate or mortgages, deeds of trust, notes that are not secured or secured by equipment or other types of things, all different types of notes. And then our last category is entities. Well, entities are things like limited liability corporations, C corporations, joint ventures, limited partnerships, trust or option contracts, or even private stock. Those are all things that we see purchased through Quest on a fairly regular basis. A lot of the limited liability C corporations, a lot of these are dealing with commercial property or buying commercial property, apartment complexes or warehouses, strip malls or centers and things like that. We see a lot of that. But there's also all types of other businesses that are owned and ran inside of the IRA. So why would you want an entity? Well, there's different reasons why people use entities when they're investing with IRAs. Most commonly, I think that you see it for grouping investors together. And this goes true inside IRAs and outside IRAs. If we're going to build a hospital or a big apartment complex or something like that, we'll have a group of investors that put their money together. You had some lead investors, that put it all together and does it, and then we pay those investors back based on the profits there. So it's a way of grouping investors together, right? And that's the main reason why it's used. But in IRA purposes, often people will use entities to help reduce their fees to their custodian, and this could make sense. For example, if I had a whole bunch of loans, I had a lot of money in my IRA, and I'm lending all the time. I'm receiving payments back on it doing all of those things, rather than paying all those fees on these loans, because they're all short-term loans, they pay off quickly, bam, 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 happen all the time, right? Well, I could have an entity in there, and what would I pay in Quest fees? Well, you'd only have one closing when we first purchased the entity. The entity can year after year after year buy and sell notes and pay them off and do all the things that it has to do inside the entity. And all you have is that one asset fee, that annual asset fee that you pay at your custodian. It can greatly reduce your fees. So that's one of the reasons that we use them. Sometimes anonymity, I always have a hard time saying that. Anonymity, a little bit of distance, by having that. Typically when we take title to things with an IRA, we'll take title to things Quest Trust Company for the benefit of Tom Jones IRA 1, 2, 3, 4, 5. And maybe Mr. Jones doesn't want everybody to know that he has ownership in that particular property or something like that. We do use entities also for tax advantages and asset protection. It's a little bit less important, I think, the asset protection part of it as we deal with IRAs, because IRAs already have their house of protection, and often the tax advantages are quite a bit different the way they work with IRAs as they do with individuals, but we do use entities often to both the legal side and the tax side. What's kind of funny is, if you've done this for a while, you find out that the attorneys who draft up the documents and the CPAs who things often have a different opinion as to what would be best or whatever, because they're running it through their filter. And of course I have my own opinion, which is my IRA filter. I see everything through an IRA. So always take what education you're getting from who you're getting it from and make sure that you understand that, including me. Like I said, I see everything through an IRA filter, right? So what are the problems with having entities in IRAs? And the biggest problem that we always deal with in IRAs that always comes up and gets us is disqualified persons. So what I'm going to do is I'm going to describe a problem, and then we're going to get into the solutions of each individual problem that we have. So let's start with describing the problem of disqualified persons. You see, there are people who are disqualified to the IRA. They're disqualified from doing any business with the IRA. They can't buy, they can't sell, they can't trade, they can't extend services, they cannot receive a benefit either directly or indirectly from any of the activities that the IRA makes. Well, who are these disqualified people? Well, let's start with the main one, which would be you. You are disqualified to your IRA. You cannot buy, sell, trade, loan, extend services, or receive a benefit individually. You see, this is why. Your IRA is a trust that's been put aside for you and has special tax advantages to it. The government gives us special tax advantages to it as long as you keep the rules, which is I'm saving that for my future. Or if it's a health savings account, I'm saving it for medical use. Or if it's an education account, I'm saving it for education use. I am using this money for that specific purpose of taking care of myself and my retirement. And I have full responsibility over this account. I can make all the decisions, and I can make whatever decisions I can make and bring my abilities and powers of thought process to this account to make it grow bigger so that when I retire, I have more money. But what I can't do is get a benefit right now. In other words, if my IRA bought a house, I couldn't go live in it. That would be a benefit. If my IRA loan money on a boat, I couldn't go play on the boat. And here's one of the benefits that get us, right? I said you can't receive a benefit either directly or indirectly, and a big benefit is money. So a lot of times on commercial projects, people might be a commercial person on that, they're the lead, they're putting their credit on the line, they're applying, they get a bunch of junior people to invest into it, and they might get 50 or 100 or 150 or $200,000 into the deal, and we get a bunch, and then we get a bank to take over the rest. Well, in that case, you couldn't have your IRA be one of those other people. You can't be the lead in your IRA. Why? Well, because in the end, you're going to get money. Therefore, that's a benefit to you. regardless of how it benefits the IRA, it's still because there's a benefit directly to you. What else would be a problem in that situation where I described, where you're a lead and your IRA is one of the investors into the deal? Well, you've extended your credit onto that deal. When you apply for the loan to the bank, that is your credit. And so that's like you're extending your credit to your IRA, and that would also be prohibited. So the big problem with disqualified peoples is you are disqualified from your IRA. You can tell it what to do, you can make it get bigger and better, but you cannot use it in your own investments in that way. And in addition to you, there are a group of people who are equally disqualified to your IRA. They're equally disqualified to you, and those people include you, your spouse, your children and parents, lineal ascendants and descendants, their spouses, and here's the kicker, companies any of those people own, control, manage, or considered a highly compensated employee thereof. So it's a pretty significant group, but it's important to understand it's not just family. You don't just throw this blanket over and say family. It's you, spouse, children and parents, their spouses, and the companies those people own or control. That's how you view it. All right. Solution. Here is the solution to this problem. There is none. Stay away from it. Very, very dangerous thing to do, and it's been tested several different times, and it has not turned out well for the people who have gone down it. I know I can come up with people who have done it and didn't have any problems, and that's just because they didn't get caught. And the government's getting better and better and better and better at doing it. When you're a lead on there, you should understand the people's IRAs you can use and the people's IRAs you can't use. And you cannot use your IRA or your spouse's or your children or your parents or their spouse's IRAs into your deal. That's it. I know it's not a very good solution. I really don't have one. If I had one, I would bring it to the table. Trust me. All right. Problem 2. Often entities and self-directed IRAs are used to perpetrate fraud. It's a sad fact that self-directed IRAs are very dangerous. And they're very, very dangerous because people prey on people's retirement. And I cannot think of a more disgusting type of thief than the person who would go after someone's long, hard-worked retirement money intentionally. This is investing, and I get it. Investing does come with risk. In self-directed IRAs, people get to choose their own risk. Matter of fact, your custodian does no due diligence. We are legally obligated to perform the transaction if it's properly vested and we have all the information filled out, where we have to go ahead and perform that transaction, even if I think it's like I could retire as an administrator, but that would be my only choice in there. So, but people do this. They do prey on people. And often whenever I see it, there's usually 2 instruments that I see when people are perpetrating fraud. One of them would be an unsecured note, but most commonly is some type of entity paperwork or something like that. So how do we avoid fraud? Well, first of all, make sure you understand the investment. Clearly understand the investment. Every time I hear one of these things, it's usually like something that's really cool, really thing. You got to understand, but you don't quite get it all, or it's a little bit hard to verify. Make sure you're taking time to do background checks on the people that you have. And I think extensive background checks. So typically, if I'm on a deal, if I'm a lender, I'm going to have my attorney draft up the documents. If I buy into a subscription agreement, that's not an option. Obviously, it's $10,000, $15,000, $20,000 to draw up those documents. That's not going to be my attorney, but I'm probably going to spend the money and pay money for an attorney to help review those documents with me. And what they're going to do is check background check. Now the attorney is not checking when you pay for an attorney for something like this. They're not checking like the full veracity of the documents. They're not going through and rewriting the documents. They're doing a cursory glance over the documents to make sure that there's nothing really out of whack. If you understand legal documents, there's a dozen different ways to draft any one legal document, and you put attorneys in a room, they'd all disagree on how to do it. So you're basically not having your attorney rewrite it. They're just checking, doing some background checks to make sure that the entities and the people involved are okay. They're going to look at the contracts and see if there's something glaringly funny or something out there. So either A, your attorney drafts up the documents for you, or B, you have your attorney look at one. That will help you to understand the investment, and that's clear. And on understanding the investment, you need to understand these things. You need to understand the timeline, how long you expect it to happen, and most importantly, you need to understand what happens when things don't happen according to the timeline or according to the plan. You must know what to do when it has a problem. In my life, the problems that I've had with investments, the ones that always end, have always been caused by several things. First of all, it was my greed. I got very greedy, and started listening to a story that probably shouldn't have, and it's easy to dupe you once your greed glands kind of swell up. I think they starve your brain to what's happening. That's hard to admit, but that's a truth of it. Also, not understanding exactly what I'd have to do in the event of a default. I mean, I know I foreclosed on one person. They were really nice people, actually, but they managed this situation, and I had to default. There was a lot of equity in the particular property, but it wasn't really a property that I wanted to own. It wasn't a rental house. It was a dog kennel on an odd piece of land, and there was a lot of oddities to this that wasn't something I wanted to deal with. But upon the foreclosure, I was forced to deal with those type of things, and I probably wouldn't have ever lent the money if I would have actively thought about not just the fact that there was equity in the property, but what would I actually do with the equity. All right. I know. Again, I refer to a lot about being a lender. So a lot of times with a subscription agreement, if it goes wrong, you're really at the float of the person that's in charge there. So I would understand, really important when I'm dealing with entities, what happens whenever it does go bust? What would I have to do? What would it look like? Often I've had commercial investments on my own, and typically when I've had problems, I've never personally lost any money on these, but the timeline got greatly extended. It took a lot longer to get the same returns that I was expecting in the beginning back. It took a lot longer to get the funds back. I think that happens commonly. But look for fraud. I mean, understand things. Here's one other thing that I'll notice about when people are perpetrating fraud with self-directed IRAs. The paperwork is either extraordinarily thin, it looks like it was drafted by a third grader, or it's extraordinarily complex. And in complexity, it doesn't really seem to run together or make sense. As you flip through the document, you might notice different fonts. It's almost like someone cut and pasted all these different things together. And it's certainly, at my point, after looking at so many documents, I can definitely tell documents that have been drafted by an attorney professionally and documents that somebody have placed together. And so I'm kind of curious. But look at the actual documents themselves. And if you do get that little feeling going off, investigate, ask more questions, take the time. Here's the next thing. Typically these type of investors, I found out something else, they're really cool. They're usually cooler than us. Most of us real estate investors are pretty, I don't know how to tell you guys this, but we're pretty, plain people. A little bit dorky sometimes. They're cool. These people that sometimes, they tend to be cool and good looking is what I call them. And the last thing that always seems to be the case is there's this huge rush to get the money right away. And if we don't, we're going to lose this phenomenal opportunity that we're going to make all this money on. Hurry, 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 hurry. We don't have time for you to do anything besides send me the money. Always a big rush. Be very cautious, guys. And whenever you feel your greed glands swelling up, as they have in my past, slow it down. Ask a few more questions. And if you feel uncomfortable, just don't do the investment, right? There is worse things to happen than not doing an investment or not participating in an investment that ended up being a good one. You can go on. It's much better to keep feeling safe and to be able to sleep at night. I can tell you I've done other investments that were really good. They paid me back, but there was a worry level that was involved in them that I would never do those type of investments again. So I believe that time and worry and concern are things that you should consider when you're doing certain types of investments. All right, here's another one, plan asset regulations. I get in trouble with this one because I know about diddly about this, but I want to mention it, all right? So I could give you a very, very cursory thing, but plan asset regulations are this. Basically, if you're raising money for, let's say, an apartment complex or a commercial deal, if you take in too many IRAs into the transaction, it could be deemed that you become a fiduciary to the IRA and you have increased responsibilities to that IRA, and it could even be deemed as a prohibited transaction if it was done wrong. How I see most people deal with this is they try to keep the amount of IRAs that they get in raising money under 25%. I honestly don't understand why the 25% level is there, but that's what I see as it gets structured. It doesn't have to be. I know that the building owner that I leased the building out of in Houston is almost 60% of its capital that was raised to purchase that building was IRAs. Doesn't mean it can't be done. It meant that there was a lot more work that had to be done to include that many IRAs, including having some actuaries and some other things involved. So what's the solution? Just make sure that if you're going to use IRAs, when you sit down with your securities attorneys to draft your subscription agreement, that attorney's familiar with the use of IRAs, familiar with the use of plan asset regulations, and what we have to do to structure to use those IRAs completely. Don't take Nathan's advice. Barely listen to Nathan, other than the fact that go talk to a competent securities attorney that understands IRAs. There's the things. Here's the biggest problem that I deal with when I'm dealing with entity investments, and that problem is, can the IRA investment be taxable? And the answer is yes, we can have taxable investments through the use of entities. Not the entity itself doesn't create the taxation, but we do have a problem of taxation that can occur. It's called unrelated business income tax. So again, it's a two-part process. First, I'm going to very detailedly describe the problem of unrelated business income tax. And then the second part of it, I'm going to give you solutions. There's a series of solutions to this particular tax, all right? So what creates unrelated business income tax, or causes an IRA to owe tax? Now, to be clear, it's the IRA that owes tax, not the IRA owner. So the IRA files its own tax return. It's called a 990P. It has to pay tax on it. Well, what would be the circumstances that it has to pay those taxes? One of them is owning a business. If we ran a business through a Roth IRA, say we had a donut shop, run it through a Roth IRA, what would happen? Well, all the profit from that donut shop would be completely tax-free. Therefore, I would have an unfair business advantage in my donut shop. I can sell my donuts for cheaper than other donuts places and still stay in business, and therefore be an unfair business advantage. The solution is, if you own a business inside of a retirement account or tax leveraged account, that is not prohibited. There's nothing wrong with it, but we have to pay tax on the income that comes from that business. Okay? Just like you would have to pay tax outside of it. Well, what type of tax? Well, here's where we kind of get into the problem too, is IRAs pay two types of tax. One type is commonly is personal income tax, just like what we pay, but we pay it at a trust rate, which means we get to that top tax income bracket really quick. We're at that 39%, somewhere around $12,000. So right away it rockets right up to that. The other way is we could pay in certain types of investments capital gains tax, which would greatly reduce that amount, so we can get capital gains treatment on unrelated business income tax for certain types of investments. So there's the problem. If we ran a business inside IRA, we may be paying would be paying either the same tax or a lot higher tax if we were taxed at that personal income rate, because it goes up right away. Renting personal property is considered running a business. This includes renting mobile homes. And I'm not talking about mobile homes attached to a piece of land. Now we're renting real estate. That is treated completely different than a mobile home. You don't own the land underneath, you only own the box, and you rent the box. Now you're running a business because that's personal property. I see this with mobile homes. I see this with containers. I also see a lot of investments that deal with like medical equipment or heavy digging equipment or drilling equipment. These are all personal property that we may buy and we might rent out as an investment inside the IRA. Why do I see this inside the IRA if it creates taxes? Because it's highly profitable. Even after paying its tax, it could be highly profitable and be worth doing. And once that profit's made, it's inside an IRA and it continues to grow tax-free. That's why people do it. I don't see a lot of people running donut shops or doing that type of stuff, but I do see people renting medical equipment, renting drilling companies, drilling for oil wells inside of IRAs, and running mobile phones. I see that all. As real estate investors and as apartment complex investors, this part of the unrelated business income tax, I would argue, doesn't get us very often. If I'm buying an apartment complex and I'm a passive investor and I put my $50,000 or $100,000 in the deal and I'm going to wait and see what happens, I'm an investor. That is investment money. I'm not running a business. I'm not renting personal property. I'm an investor and I don't get hit with it. So then what's the problem, Nathan? Well, there's another side to it. And again, right now I'm defining the problem and then I'm going to give you the solutions. All right? That is debt finance rental income and debt finance capital gains. And basically what I'm talking about here, guys, is if we buy a property and that property is debt leveraged or has a loan on it, to the extent that it is debt leveraged, we must pay tax on that. Let me see if I can explain this to you in a short story. My IRA goes out and wants to buy a house. The house costs $60,000. All right? I'm sorry, $100,000. I don't have $100,000. I have $40,000. I take $40,000 and I put it down on that house and I get a non-recourse loan, maybe from somewhere like North American Savings Bank, NASB.com. Get a non-recourse loan. In other words, I'm not extending my credit to that loan. The IRA itself is getting the loan. And I got a loan for 60%. Okay? That means I was 40% debt leveraged. At the point, the very next day, let's say I sell the house for $100,000. Okay. If I sold that house for $100,000, what would happen? Well, sold it for $200,000, getting $100,000 in profit. What would happen? Well, I had $100,000 profit. I only held that property for what? 1 day in my story, right? And so I'm not going to get any capital gains treatment. I'm going to get taxed at personal income. Well, what happens? Well, remember, I'm only taxed on the debt leverage percentage, so I put $40,000 down. That means I was 60% debt leveraged. That means out of that $100,000, $40,000 goes to the IRA tax-free, $60,000 subject to tax, taxed at what rate? Ordinary business rate, but like I said, it hits that top rate really fast. So boom, you're going to cut off $25,000, something like that, and half of that $60,000 and send it to Uncle Sam as unrelated business income tax. And I give this example a lot, and I'll ask people in a crowd, I'll be like, hey, would you do that deal? And everyone goes, no, I wouldn't do that deal. And I'm like, listen to my story. I started with $40,000, and in one day I got my $40,000 back, plus another $40,000, and I split $60,000 with Uncle Sam. Sign me up. I do that deal every day of the week. The problem with the story isn't the story. The problem is it's not real. We don't buy a property for $100,000 and sell it for $200,000 the next day. That's not how it works. So sometimes people hear that word taxation and they just shut off, that I shouldn't do the deal at all. That's not necessarily. We should analyze the taxation and see how we did. Okay? And most of the time when people are buying debt leverage property, to be clear, we're holding that property for over a year. We do get capital gains treatment, and we have other ways to deal with this problem of unrelated business income tax. But here's the really bad news. Just because I use an entity, like an LLC, and I purchase a complex, and I'm a minor investor into that complex, and they take my money, they mix it with other investors' money, and then they go borrow a bunch of money from a bank and buy a big apartment complex. My investment is debt leverage, and my investment is subject to unrelated business income tax. And often the people who are raising money may not want to talk about this ugly little detail. So there's the problem, guys, is we could pay a tax. The tax could be highly onerous in certain circumstances, and we may not have gotten proper education from the people who we're investing with in order to know how to deal with it. There's the problem. Here comes the solutions in no particular order. Solution one, again, this slide just demonstrates that it pass-through entities like LLCs, grantor trusts, partnerships, all of those, the taxation of unrelated business income tax passes through, right? And again, don't get confused. It is the IRA that pays the tax, not you. It's a separate tax return. It doesn't affect your tax returns. It's completely separate, okay? And it can either be capital gains rate, or it could be the trust rates, which could be really high as personal income tax, all right? Why would you do it again? Well, I think I've touched on this. The reason why people sometimes do taxable investments in the IRA is, yes, they pay tax inside the IRA, they pay tax outside the IRA, but once it's inside the IRA, it's still inside the IRA. Continue to do another investment again. And so sometimes it's used to do investments to jumpstart, or like I said, just the amount of profits there, and it makes sense to go ahead and pay that tax, right? So here we go. Solutions to the UBIT problem. Here they are. Depreciation, invest in a taxable entity, loan don't own, and a 401k exemption. We'll start with the very first one, depreciation. I love this conversation with certain smart people, because I'm not always the most educated person in the room. But I get these really smart people, and they go, well, Nathan, I would never, ever, ever own real estate in an IRA. And I go, oh, why not? They say, well, you lose depreciation. Depreciation is one of the most powerful things about having investment real estate, is having a depreciation. It's one of our best tools. And so if you own real estate in IRA, you don't get any use of depreciation. And I have to step back and ask that person. I said, well, I guess I'm a little bit confused, because you're making this analysis of whether you buy the property in an IRA or outside the IRA, and that's not really the analysis, because my money that I have to buy this property is in my IRA. It's not outside my IRA, and I have to invest this money in something. And my choices is I can buy real estate, or I can buy stocks, bonds, mutual funds. I'm pretty good at buying real estate. I know how to find a deal, I know how to find a renter, I know how to fix her up, I know how to market it, right? So if I buy real estate and continue to do that over a period of time, when I get to be older, even without the use of depreciation, I'll have a lot more money than if I buy stocks. Isn't a lot more money better than a little bit of money? I mean, they literally overanalyzed the tax problem with it before they have, it's like they can't see the forest through the trees. When you're dealing with your IRA, you should invest in what produces the most amount of return. That should be the focus of your investment. Now, why is it that an IRA doesn't get any use of depreciation? Well, guess what? In order for you to get a tax deduction like depreciation, you have to have a tax. And since IRAs are not taxed, the money grows tax-free, you don't get a tax deduction. That's how that works. So, but if we do a deal that is debt leveraged, now we have tax. And if we have tax, we get deductions. And that's amazing, but something happens inside an IRA that doesn't happen outside an IRA. Let's go back to it. If we buy a property and we debt leverage it, and say it's a rental property or even an apartment complex, what would we do? We'd use depreciation so that we wouldn't have to pay all that tax on that rental income. But does it really make the income go away? And the answer is no. What it does is it pushes the tax off to the future. And when we sell that property, we have to recapture it at that point in time. And then we can do the 1031 exchange, continue to swap or whatever else. But in order to take the money out and spend it on something cool, we have to pay that tax. So it doesn't make the tax go away, it only pushes it off to the future. Let's jump back into the IRA world. Let's do that thing where I bought that house for $100,000, I put $40,000 down, but instead of a flip, it's a rental property. I'm gonna buy and hang on to it. And what I'm gonna do is I'm gonna rent it, I'm gonna get my rents in, and the rents will cover the mortgage and vacancy rates and repairs and maybe a little bit of cash flow. And over time, that property will go up in value and I will be paying the property down. That's my plan for this particular property. All right. Well, because taxation kicks in, guess what? I can use depreciation, file a 990T, and push my taxation off to the future, just like I would if I had a rental property. But again, amazing difference. We only pay tax inside an IRA to the extent that it is debt leveraged. When I purchased the property, I put $40,000 down. I was 60% debt leveraged. If I use depreciation, push that taxation off to the future, is that I'm always going to be 60% debt leveraged? No, I'm not going to always be 60% debt leverage. I'm going to continue to pay that tax down. And if I could pay down the tax or pay down the property prior to selling it, what would happen? In other words, if I got to what we call an average indebtedness of zero, in other words, I've had the property for over a year without any debt on it before I sold it, how much tax would I have to pay? Zero, because I have no debt leverage percentage. So one of the solutions is depreciation. What we use, we just use depreciation to push that taxation off to the future while we rapidly try to pay off the loan prior to selling it so that we don't get caught with the depreciation or have a very small amount of debt leverage. Now, does depreciation solve all the problems? Obviously not. If you start to think about it, if I buy an apartment complex, what do? I buy an apartment complex, it's kind of all run down, it's a mess, I fix her up, I get better tenants in it, I do take care of the deferred maintenance and make it look better, and then what do? Well, the place appraises more because I have more income on the property, I get a larger loan, and I take it out. So often, when I'm dealing with commercial property, the end result is not me paying off the loan, but it could even be me getting a bigger loan. That could be one of the things that you do. So again, depreciation is not the solution for all, but for some people that are facing long-term rental gains, by buying debt leverage property, depreciation might work really well for you. Okay. The next one is what I call structure. We're using a C corporation. With the C corporation, the C corporation is unlike a limited partnership or an LLC. Those are what we call pass-through entities. In other words, we pass the taxes through to the beneficial owner. There's no taxes paid. But C corporations don't work that way. We pay a corporate tax at the corporate level. This does not make the tax go away, but it can make the tax manageable, right? Think about it. If you had a Coca-Cola stock in your IRA and you get a dividend from it, you don't have to pay tax on that. Why? Well, it was paid at the corporate level. So the reason why we don't use corporations whenever we're dealing with apartment complexes and stuff is most of our owners are persons or people, not IRAs. And the tax treatment for people are different. If I had a C corporation and I owned an apartment complex, and not an IRA, just me personally, I would pay tax at the corporate level, and then I would get my dividends, and then that would be treated as income, and I'd have to pay tax again, or that's what we call our double taxation.
So it could hurt us. But with an IRA, if I paid that tax at that corporate level, any of the money that flows through comes tax-free. Doesn't make the tax go away, but if I were going to run a business, rent personal property, have an oil well, or do any of these type of things like this, maybe having a C corporation as an entity in there instead of an LLC would have been a better choice, because I could pay a corporate tax, which is most likely going to be considerably less. So I have seen attorneys do this. They've set up an LLC and they put all of their people directly owning into the LLC. Then they formed a small C corporation. The IRAs bought into the C corporation, and then the C corporation invested into the LLC, thus letting the IRAs have the structure of the C corporation, which is beneficial to them, and the LLC having the structure to the other investors, which is beneficial for them. It may not work in every circumstances, but again, my job is to provide ideas and give you my view from an IRA custodian side. So one of the things, one of the solutions is use a C corp. Certainly if I was going to run that donut shop I was talking about earlier, this would be the solution I would use there, because this would allow me to just pay the tax at a corporate rate. Solution 3, loan, don't own. This works sometimes, typically on smaller commercial deals. I find that we're trying to raise money from people. Why put the IRAs always in a position of being a limited partner or an owner in there? Sometimes the IRAs can just get a return and be in a safer position by loaning to the investor. And this is interesting if you think about it. It does shift some tax preferences to the general partner, which might be good for him as well. Where you run into a problem with structuring as a loan over owning it is sometimes we're also going out and getting a loan from the bank, and the bank may not want to have another lender on there, even if they're in a second lien position. So I've seen that. But with smaller deals where we're maybe not going out and getting debt, we're just getting a group together, maybe what you do is you have your IRAs loan the money into the deal, the other people put the money in, and you work out some structure like that. My fourth solution, it's like the magic bullet to the unrelated business income tax problem. That is a solo 401k. There is a product that we have called an individual or a solo 401k. It's pretty cool. It's an account that can do some things that none of the other accounts can do, including have checkbook control. It's got great big contribution limits. It's got loans to yourself. But the biggest thing is it's got an exemption specifically on UDFI, or unrelated debt financing, as it relates to unrelated business income tax. So what I'm talking about is if we buy that house and that house has a loan on it, or an apartment complex and that apartment has a loan on it, and we do this through a 401k, and it is a long-term thing, so we've held the project for more than 1 year, literally this tax just goes away. It's amazing. So, and we can move in our IRAs, our old 401ks, our traditional IRAs, all into this 401k. We can do conversions inside the 401k and convert it from traditional money to a Roth money. We can have Roth contributions to this 401k that are very large, very flexible. Well, why would everybody have them? Well, the 401k comes with its own little set of problems, and this is the biggest problem, is what I call legitimizing. And you can't just have a 401k because you go, golly gee, I want one, look at all those cool things it does. You actually have to have self-employment income. How do we know you have self-employment income? You report it on your taxes and pay tax on it as self-employment income. And then the last step of the legitimizing process is you have to make a current year contribution into that 401k. So it has the limitation is that, A, you have to show self-employment income, and a lot of us don't have that. And there's a second part. It's what's called a solo 401k, so you can't have any employees, including in any other businesses, because there's grouping rules. So as soon as you have employees of any type in any business, well, not any type, you can have contractors, but any W-2 or what we call common law employees, then you wouldn't be qualified. So for large portions of
the crowd out there, we either don't have income to legitimize it, or we have employees. Both categories makes this us ineligible to have this account. But if we were eligible to have this account, we could move in our traditional IRAs or SEP IRAs or 401ks, transfer those in, make a small contribution that year to be able to make sure that it's legitimized, or a large contribution. And then once we make the investment, it would be completely tax-free. I will say, though, you cannot move, oddly enough, Roth IRAs into a Roth 401k. We can convert to a Roth IRA inside the 401k, but we can't move that money in. 401ks are very complex in themselves. We have a 401k class. I have a 401k expert on staff. Her name's Rebecca Miller, rebecca.miller at questtrustcompany.com. You can also get information on our employer plans class that we have online here. So one of the solutions may be to figure out how to get a solo 401k and use the magic bullet solution and make it completely go away. So just some key points to today's topic. You should not be the managing member of an LLC owned by your IRA, period. You shouldn't do it. You always, whenever we're setting it up, if we're going to set up any type of entity, we're going to put somebody else in there to be that managing member, whether it's small or large. Our IRA must always just be an investor, okay? Yeah, if the LLC operates as a business, like a sale of mobile homes or owning debt finance property, they would be subject to unrelated business income tax, right? You cannot guarantee the debt. In other words, so you can't extend your credit to the investment that your IRA makes. And neither you nor any disqualified person can work for, get paid, or get a salary from the LLC or get money. The money must all be for the IRA. If you receive money, that would be clearly a benefit and see. But there is something I didn't talk about here, which is the last little point here, is partnerships and split ownerships are allowed. I could take my IRA and my wife's IRA and my son's IRA, and I had a lead that was looking for investment that took $100,000, and I'm qualified as an investor to participate in that. I can use my IRAs, my wife's IRAs, and even my son's IRAs to complete that $100,000 obligation. Remember, even if it's a $100,000 minimum, I had only 60 in one IRA and 20 in the other and 20 in the other IRA for the total of $100,000. To the securities attorney, I'm only one entity. I'm Quest IRA, and I'm purchasing this subscription agreement for the benefit of these other IRAs. And so for them, reporting tax-wise, when they have to fill out a K-1, there's no extra work for them. So usually this works really well, puts partnerships together like that. Guys, if you have any more questions, write me an email. My name's Nathan at Quest IRA. Sometimes I'm hard to get on the phone. I won't lie, but if you want to get me on the phone directly, just ask for an IRA specialist. Ask your question to them. 99% of the time, they're typically smarter than I am and better at answering the questions than I do. But if they can't, then they'll track me down and look for me, and we'll have a discussion. Hopefully this has provided a little bit of education to lead you to make good investment decisions, ones that are take you time to make sure that you're dealing with people who are trustworthy and have done it and aren't perpetrating fraud. Thank you again. I hope you enjoyed this little educational series that we have here at Quest.